Assalamu alaikum everyone. In today's lecture, we're going to look at some more examples of cash flow forecast. Previously, we talked about some cash flow forecast like this, how we got calculate X. We looked at an example. So let's today look at how we can construct a cash flow forecast from scratch. Okay. So let's suppose this is a question. Sorry, it's a little blurry. I tried my best, but that's what we have. So I'll just read that for you. Tourist Trinkers Limited owns a warehouse supplying company. So these are the forecast sales in $1,000. January it's $6,000, $8,000, $8,000, $14,000, $16,000, and $18,000. They have given up to 6 months forecast sales. Now, on a past experience, 50% of sales will be cash sales. So they have forecasted that they will get 50% of sales cash. So of course, the remaining 50% will be credit sales. 1 month's credit is offered for credit sales. So that's identify that the remaining 50% are credit sales. Stocks are purchased in the month prior to sales. So February's stock is purchased in January. January's was purchased in December. But and what was the amount of stock? Sufficient stock, which is 50% of sales value, is purchased to cover the following month's sales. So the value of that stock, the cost of that stock is basically 50% of sales value. So $8,000 was the sales made in March. 50% of that is $4,000. $4,000 was the cost of stocks which was purchased in February. But here's the fun part, that suppliers allow 1 month's credit on purchases. So that means the cost for purchasing $4,000 supply for March, which was done in February but paid in 1 month later, which is March. Okay, so March stock is in turn paid in March only. That's the trick part of this question which you need to analyze. Other expenses are labor costs that are $6,000, $600 per month, except May and June when it is $12,000. Rent of $1,800 per half year, which is payable in January and July. Since we only look at June, so we just ignore July and we'll just include $18,000 in January. Electricity charges $600 per quarter, paid in January, April, July, and August. We'll only include January and April. Advertisement of $100 per month, except June when it is $500. Ignore the spelling mistake over here. They've written month, it's actually month. Interest charges of $1,000, which is payable in May only. Management salaries of $2,000 per month. And opening balance on 1st January is $1,500. They've given you all this information and they want you to construct a cash flow forecast. It's a 10-mark question, but do know, I'm saying this again, you won't be asked to construct a cash flow forecast from scratch in exams. You might be said, generally they ask you to calculate a certain value, like this question we had over here that we calculate X. They could also have asked you to calculate a certain value from in between, or this, opening balance, closing balance. They can ask you to calculate any one thing as well. Or they can say, okay, they have made certain changes at the start of the month. Let's say the employee cost, the revenue that they got in 1 month, first month, was $6,000 instead of $12,000. So what will be the new closing balance? So just because of this one small change, there's going to be one big change in the closing balance last. So they will ask you to calculate that, but of course not for the older 6 months. They might say, okay, they might just give you 3-month data. Okay, they say there's just small change over here in month 1. What will be the effect of closing balance on month 3? Okay, so you have to first calculate the month 1's closing balance, then month 2's closing balance, and then finally month 3's closing balance. Why? Because we need the opening balance as well, which is the closing balance of previous month. We'll look at a similar question for that as well, but for now let's look at this question. We have all the info we need. So here I've written down all the info over here. 50% of our sales are cash sales, 50% are credit sales. This information is provided from here. Then stock costs are 50% of sales value. They've told over here the sufficient stock, which is 50% of sales value. Okay, and the information that they have get is that stocks are purchased 1 month prior but paid a month later. Okay, purchased 50% of stocks are purchased in the month prior to sales. Okay, and they have given that information and allow 1 month's credit on purchase. That means it is paid a month later. So example is that stocks for January are purchased in December, but the payment is made in January only. stock for February are purchased in January, but payment is made in February, and so on. Ignore that, there's on the missing. 7,000 is the cash sales in April. So let's just look at an example over here, that what will be the cash sales. So 6 April I've chosen the example. 14,000 was the overall sales made, but 7,000 of that will be your cash sales, and the 7,000 will be credit sales, which we will get in May. So we don't look at the other 7,000. And the 4,000 credit sales of March. Okay, in March we got $8,000 sales overall, out of which 4,000 was cash sales, 4,000 was credit sales. 4,000 of cash sales was accounted in March, and the remaining 4,000 was accounted in April. We have over here 4,000 credit sales of March is received in April. So the total cash inflow will be 11,000. How do we got that? Cash sales of April and credit sales of the previous month, which is March. So I hope you get that idea clear. Do clear this point out. That's the tricky part of this question. So the stocks for April was purchased in March but paid in April. That is $7,000, 50% of $14,000. So stocks were purchased in March but they are paid in April. So let's construct that cash flow over here. Here's the cash flow forecast that you were asked to construct. I was just giving an example, okay? Don't actually have to construct that on paper, because of course it's going to take a lot of time, and it's generally for 3 months, but this is only for your own understanding of cash flow forecast. So as you can see over here, we have a month: January, February, March, May, June. Then we have a cash sales and payment for debtors, or I've said that credit sales. Okay, so December there was no sales data given, so we don't do that. 3,000 over here, 3,000 over here. 6,000 was the total sales in January. 8,000 was in February, 8,000 in March, 14,000 in April, and 16,000 in May. That was all given over here. Okay, but we just switched that, and 18,000 was in June, but 9,000 of that over here. 9,000 is in July, but we don't look at July. Okay, all of this information was given. We just have to place that in the correct order. So we got the information. Then credit sales part was there. Okay, so credit sales 50% was cash sales, 50% credit sales, which are received in next month. Okay, so that information, I hope you got the inflow part clear. Then we look at the credit part. So okay, 6,000 was our overall sales and 3,000 was the stock cost. Okay, 3,000 we purchased this in December, but we pay that in February. Okay, we purchased this $4,000 sale was purchased in January but paid in February. So just that over here, it was the 50% value of your sales made, so that's why 50% is it's the same as cash sales, because cash sales were also 50%. Your payment that you're making to your creditors is also 50%, but 50% of total sales. Okay, so just keep that in mind. It's a little confusing, but you have to read it again and again to clarify this topic point. Then all of the other data was given over here: labor cost, rent, electricity charges, advertisement. We just put that over here, simple order. Okay, as it was required. Okay, $500 extra over June, interest charges, manager's salary. So we just add all of those up, and we have a total cash outflows. We've written that in brackets because it's a negative value. Okay, so we have all those total cash outflows over here. Then we calculate a net cash flow. It is not a requirement, but you need to have it for better, like easy calculations. Okay, so we have a net cash flow over here. I have just total inflows minus outflows. Okay, inflows minus outflows, inflows minus outflows, inflows minus outflows. That's how we got our net cash flow. Then we were given the opening balance of this month. We weren't told about the closing balance. Okay, so we had to calculate that. We calculated the closing balance of month 1. Now closing balance of month 1 is the opening balance of month 2. We knew that, so that's how we got the opening balance of the next month. We calculated the closing balance of month 2. Then the month 2's closing balance was the opening balance of month 3, that is March. We calculated the closing balance of March, which is the opening balance of April. We calculated the closing balance of April, which was the opening balance of May. Then we calculated the closing balance of May, which was the opening balance of June. Then we calculated the closing balance of June, which is the opening balance of July, but we don't look at that right now. So that's how we got our cash flow forecast. The whole point of this question was like just to get you familiarize you with cash flow forecast to, you know, polish your concept of that. Now just look at another question. This was a little confusing at first. I was also confused when I was attempting that question at my time of studying. So yeah, it happens, but I hope you get the idea. Now in the question they have given you this data over here. Okay, they have said it's a cash flow forecast for a certain company, that they have a revenue is the only source of cash inflow, so total cash in is just revenue. Then they have cash outflows over here. There's labor, there's inventory storage, there's expenses, and there's total cash out over here. They have also given, they haven't written net cash flow. We don't need to know that, like we can calculate that easily with the formula that we had. Remember, closing balance equals to opening balance plus inflows minus outflows, so that's why we don't necessarily need net cash flow right now. So they have given opening balance as well, they have given closing balance, they have given all the data. What they want from us is that calculate the new closing balance for month 3 if the inventory storage cost for each month increases by 20%. Now this is the question I was referring to, like sometimes questions may come that they change a little certain, they only make a small change and that causes a big impact on the overall change. So well, in this particular question, the change that they have made is this inventory storage. They have changed this inventory storage. How much? 20%. So 20% of $10,000 is $2,000. So I've added that over here. Here, inventory. I've just added that over here. 10 plus 2, 5 plus 1, 50 plus 60. This other part, the 10 plus 2 is the 20% of $10. So 10 plus 2, $12. $12,000. Okay. 5 plus 1, $6,000. 50 plus 10, $6,000. These are your new inventory. Okay, this is the only change that was made, that was told to us. But because of this change, our outflows changed. Okay, total outflow changed, and because of total outflow changed, our closing balance for month 1 changed. Closing balance for month 1 changed. Our opening balance for month 2 also changed, and our opening balance for month 2 changed. Our closing balance was again changed. So you see there's a general trend going on. So how did I calculated this over here? Okay, I used the new inventory. Using the new inventory, I got the total cash outflows for month 1. That's $167. Put that in the formula over here. Inflows are the same. Inflow minus outflow, I got net cash flow. Add that with opening balance, I got the closing balance of month 1, which was $103,000. That is also the opening balance of month 2. So I put that over here, 103. Then use the formula again for calculating the closing balance of month 2. 103 plus 300 sales over here, minus 161. We don't use this data, we use this new outflows. Okay, minus 161, we got 242. That is the closing balance of month 2, but also the opening balance of month 3. So again, using the data for what we got earlier, opening balance of month 3, we would put that over here. Inflows we already know. Outflows we calculated using the new inventory, 215. Okay, not 205, it's 215. So using that information, we got the closing balance of month 3, and the final answer is your $127,000, or you can just write 127, since this is the months are already in $1,000. So if you wrote 127, you got all your 3 marks. You'll get 1 mark for each step perhaps, but if you didn't show any working, you just showed 127, you'll get all the 3 marks as well. But you need to have some working, so just in case you mess up somewhere, or you know where you got wrong. Okay, you don't want to make any mistakes. Any small mistake can result in a loss of all 3 marks, so you want to avoid that. Hence it's better to write all the steps. These are the 3 steps that we need to know. But in order to calculate the outflows, I also needed to visualize what will the inflows look, right? So I just visualized it over here. So if you want to know how will the new cash flow forecast look like, I have that over here as well. This is how it looked like. Okay, the inventory storage has changed because of that cash flow outflow change, and then we calculated all of these. Okay, the closing balance we calculated. So that's all. Our final answer was 127. Okay, we got that over here from here. So that's all for today. I hope we are now done with the overall understanding of cash flow forecast. In the next lecture, we're going to look at how we manage cash flow forecast. Allah.